Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. Stocks rising to all-time highs for the third straight day, led in part by Facebook, the social network unveiling a new set of tools designed to expand shopping on its platforms. It is all part of Facebook's broader push to capitalize on online shopping in the midst of the COVID-19 pandemic. Meantime, more market optimism coming ahead of remarks from Fed Chair Jay Powell on Thursday. Investors are interested in the path forward for monetary policy in the midst of an economic recession. And it is day two of the Republican National Convention. First Lady Melania Trump and Secretary of State Mike Pompeo on the list to speak tonight. Joining us to talk about how the markets fared today, our very own Abigail Doolittle, who's been watching the back and forth. Abigail, more record highs. Lots of earnings after the bell as well. What are you tracking?
Well, let's start with those earnings because we have a mixed bag, but mainly to the upside. In fact, some of the stocks are really soaring in the after hours. So right in the hub of technology, Hewlett-Packard, you can see in the after hours up nearly 6%. And they have beat adjusted earnings. Very strong quarter, but it was the view that beat that investors really seem to like. Plus, the CEO is saying that they see robust demand going forward driven by big data. So clearly being rewarded right now post-close. Autodesk, the software company, on the other hand, down 2.8%. Their adjusted earnings midpoint view misses, and this may have something to do with the subscription model. We'll have to take a look at that as more information comes out. But right now, a little bit of a view there, or a decline, I should say, in after hours. But Intuit, the small business and tax company, also up sharply, up 5.6%. Similar to HPE, they beat the highest earnings estimate and revenue of $1.8 billion, nearly doubled year over year. So some of these tech companies, again, the story of the haves and the have-nots. So we're looking at a couple of the haves relative to the pandemic. You were mentioning record highs during the day. That was the case. Interesting, though, Emily, it was a mixed close even with those record highs. So the S&P 500, the NASDAQ, and the New York FANG index, that index of the mega cap companies, Apple and Alphabet and others that we often talk about, all closing at record highs. The Dow down slightly. Apple also actually had its first down day in 6 days. Yesterday, of course, as you know, is the record date for that 4-to-1 stock split. So investors, interestingly, since value is not created out of stock splits, a little bit less interested in Apple on the day.
Meantime, Abigail, as you've been speaking, some breaking news across the terminal. Palantir has officially filed for a direct listing via the New York Stock Exchange under the ticker PLTR. This is something that we were waiting for. Palantir, of course, the data intelligence company that works closely with governments, known as a very secretive company. It'll be interesting to watch how they handle going public, if you will. Also, talking about that Dow reshuffle, as you mentioned, we've got Salesforce earnings out. What are you seeing there?
Yes, and on Palantir, that's sort of interesting because it's such an interesting environment to be coming to the market right now, irrespective of the methodology, Emily, because some are saying that, these gains are going to continue going on. So you have this bullish environment. Others, on the other hand, one of our guests this afternoon was saying that this could be the top. So again, an interesting time. As for those Salesforce earnings, this is the clear after hours winner. The stock is up about 16% in the after hours. They put up a huge quarter, the adjusted earnings beating, the second quarter revenue beating. They raised the fiscal year view. Lots of acquisitions in there. And on the year, this has been the story as well. Salesforce really beating the S&P 500, up about 40% on the year. Not quite as much as some of those other, mega cap stocks. And this is not really included in that bunch. But something that's positive, one form of their revenue, the remaining performance obligation grew 24%. That's a bit of a forward look. So it looks like Salesforce, in terms of the subscription model, their footstep in the cloud, really benefiting them, really put up a nice quarter. And again, that outlook, a full year outlook in this environment, really pretty incredible, Emily.
All right, Bloomberg's Abigail Doolittle, thank you so much. We're going to talk a little bit more about Salesforce in just a minute, but just to recap, Palantir officially filing to have a direct listing on the New York Stock Exchange under the ticker PLTR. Not planning to raise any proceeds in the listing, but we'll have 3 to 4 classes of common stock. This is a company that is losing money. We're going to talk a little bit more about Palantir and the IPO going public pipeline a little bit later in the show. But first, to Salesforce, I want to bring in the CEO of Groove, who's joining us now to discuss Salesforce results. Chris Rothstein, head of the sales engagement platform Groove. Chris, what is your takeaway from the overall Salesforce results? Of course, it's a company that has been benefiting in the midst of a pandemic, as you see other companies scrambling to make the digital transformation necessary to survive in this world.
Yes, thanks for having me on the show, Emily. And as Abigail said, their earnings were, they performed very well again. They beat their expectations. Their first quarter over $5 billion in revenue, solid 29% year-over-year growth. And I think that's because they made this big transition from a CRM to a highly diversified company that's going to do very well in this environment when many organizations are going through digital transformation and they're looking to align with a vendor that's cloud first. And that's why I think Salesforce is really benefiting from this move to remote.
Salesforce's market cap is now bigger than Oracle's, which I think maybe a young Mark Benioff never would have imagined in the early days when he was an Oracle employee. Is this a rising tide lifts all boats phenomenon, or is Salesforce capitalizing on these trends better than the competition?
I do think Salesforce is capitalizing on the trends. I think they got a few things really going for them. One is they've really built their ecosystem, and now all new companies are building for them first. And when a customer or a potential customer decides to buy a solution in enterprise, they often want to find something that's future-proof. And when all these new companies are really focused on Salesforce first because they're seen as the leader in cloud, that puts them in a really nice position. And that's why I think in July they did take over the market cap of Oracle, even though, like you said early, they didn't even barely take them seriously, and now I think they're really leading this transition to this digital transformation that many of these enterprise companies are going through.
That said, could Salesforce see a retraction in business as life returns to normal?
Yeah, I think there's always that possibility. They do. Their earnings tend to be very predictable just because their average contract is 12 to 36 months, and then they recognize the revenue. So it will take a period of time before you'll see that. And if you do, I do believe we'll see that more in the smaller business segment, where there's probably more organizations impacted, and they also have a lot more competition in that segment.
So what are the biggest challenges that Salesforce faces? What are the biggest competitive threats?
I think the largest competitive threat is probably Microsoft. When Microsoft made the acquisition of LinkedIn, that really changed the game as far as giving them a really nice way to compete with Salesforce. They haven't been able to fully take advantage of that. I do believe they are making some strides, but if you look at market share, Salesforce continues to take more and more market share. And then the second thing is they could be disrupted with a newer competitor that comes from a very different angle. You saw an organization like ZoomInfo went public, and they're more of a data provider, and so on. There might be other solutions in the AI space that will kind of try to go after Salesforce from a different angle, but Microsoft is the most concerning.
Microsoft, of course, bought LinkedIn back in the day. Salesforce has been quite acquisitive as well, buying Tableau, Velocity, Click Software. Are you expecting Salesforce to do more big buys in order to expand its reach?
Yeah, I definitely think so. If you look at their strategy, I think those acquisitions are working out, and I think they've really, this transition from a CRM to a highly diversified cloud company is working out, where they're selling to every different department in a really nice way, and they can just kind of leverage their strength and continue to become more and more important for every one of their customers and provide more and more value, and the key to that is acquisition. I think the Velocity one in particular is very interesting to show where they're going.
All right. Chris Rothstein, the CEO of Groove there. Thank you so much, Chris, for joining us. All right, coming up, back to that breaking news. Palantir filing for a direct listing on the New York Stock Exchange under the ticker PLTR. We're going to talk about all of that with Jay Ritter, a finance professor from the University of Florida, also known as Mr. IPO. That is next. This is Bloomberg. Back to our top story, Palantir filing for a direct listing on the New York Stock Exchange under the ticker PLTR. Our next guest predicted Palantir was likely to go the direct listing route. With a valuation of at least $20 billion, it is on track to be the largest Silicon Valley tech listing since Uber. For more on the IPO landscape and tech in particular, we've got Jay Ritter with us, also known as Mr. IPO, Cordell Eminent Scholar at the University of Florida's Warrenton College of Business. Jay, thank you so much for joining us. As always, first of all, you called it. What is your take on this Palantir news?
Obviously, it's not a surprise to me. The company's been close to cash flow break even. They've got a lot of cash on the balance sheet. So it's a company that can afford to be listed without raising money. And furthermore, as a tech stock, doing a traditional IPO put it in danger of leaving a lot of money on the table.
That said, it's a company that is losing money, which is not unheard of for a tech company going public. How enthusiastic do you think investors are going to be about this company, which has historically been incredibly secretive?
Well, the secretiveness doesn't bother me much. There are other companies that have military business where they don't go into a great deal of detail about the exact technology they use. And Palantir's got a lot of commercial business as well. They've got great technology. The fact that they're not profitable 16 years after being founded is a bit worrisome, however. The cash flow situation is better than their profitability for two reasons. One reason is a lot of their contracts, the customers are paying up front, and that certainly helps their finances. But also, they've been giving a lot of stock-based compensation, and that results in less cash flow. But on the other hand, shareholders are constantly being diluted as the stock-based compensation gets cashed in by employees.
Now, what do you make of Palantir choosing a direct listing when another huge company, Airbnb, we had reported they were considering a direct listing, but ultimately they're going the IPO route? What are the benefits and the drawbacks of a direct listing versus a traditional IPO?
Well, I think with Airbnb, they're probably pursuing a triple track strategy, possibly a merger with a SPAC, possibly doing a direct listing, very possibly doing an IPO. But by having the possibility of doing a merger with a SPAC or a direct listing, that gives them a little bit better bargaining position with underwriters for a traditional IPO. For companies like Palantir and Airbnb that are big, successful, albeit not especially profitable companies, they're going to get a lot of investor attention, and they can afford to do a direct listing because they don't need to worry about analyst coverage. With a company doing a direct listing, they're not paying as much to underwriters, and not as many underwriters are going to have their analysts cover the company. But with a traditional IPO, there's a danger of being underpriced by a lot. The average tech IPO this year has had a first-day return of 71%, the highest since the internet bubble 20 years ago. And that's leaving a lot of money on the table. And I think that's one of the reasons why Palantir, Asana, other companies are planning on doing direct listings.
What do you make of evaluations at this time, especially given that a lot of these companies have suffered because of COVID, Airbnb specifically? Palantir is a bit more of a black box.
Yeah, since Palantir is mainly business to business, I don't think they've especially been affected by COVID. Airbnb obviously has, but that Palantir, even though it's been around for 16 years, is rapidly growing. It looks like they're going to be hitting $1 billion of revenue this year, and they've got upside potential. But if we're talking about a $20 billion valuation, we've got to have at least $1 billion of profits per year in the foreseeable future. And that might be a bit of a stretch for Palantir, because unlike some other tech companies, they don't have as much scalability. They've got relatively high marginal costs for incremental customers as they tailor their software for that customer. And I think that's one of the reasons that I would have a concern about the valuation. It's a great company, but at too high a price, it doesn't mean it's going to be a great investment.
Palantir, of course, perhaps best known for its billionaire chair, Peter Thiel, who also co-founded the company that does data aggregation and analysis for many customers, including customers, the U.S. government, the Defense Department, the Department of Homeland Security. That said, you mentioned Asana. We also know Snowflake, Unity, DoorDash planning to go out of the gate in the fourth quarter. Which ones are you tracking and could potentially bring us some surprises?
Well, Airbnb is going to get the most attention because, millions and millions of consumers have used it, whereas some of these other companies like Palantir, Snowflake are not exactly household names. Obviously, when you're in the B2B business, you don't have that same brand name recognition among the general public. But among investors, these companies are growing. Snowflake is younger. It's got some substantial losses, whereas with Palantir, their losses are not growing faster than revenue. And so Palantir is a safer bet. Airbnb owns its space. Companies like Snowflake that are likely to be going public at very high price to sales ratios are setting themselves up for disappointment if they don't deliver on those very optimistic growth expectations.
All right. Jay Ritter of the University of Florida, great to have you on this late-breaking news. We're obviously going to continue to follow this story. We'll continue to bring you highlights from the S1 as we get them. Still ahead, an early victory for Apple in its battle with Epic Games, why the iPhone maker doesn't have to immediately reinstate the video game on its App Store. That's next. This is Bloomberg. Apple has won an early court victory in a fight with Epic Games. A judge spared Apple from having to immediately reinstate the video game on its App Store, but she also blocked Apple from limiting Epic's ability to provide key graphics for other apps. To discuss, we're joined by Bloomberg Tech's Mark Gurman. So, Mark, on one hand a win, on the other a loss. What's your take?
Yeah, my take is that the judge did the thing that I think most people online or Twitter are saying was the fair move, right? She's saying that Apple does not have to be forced to put Fortnite back on the App Store in a form where Fortnite violates the agreements. But she definitely criticized Apple for some antitrust practices and said that their move to block Unreal Engine, which is Epic Games' graphics technology, was retaliatory. So she made the decision to say Apple cannot block the developer account that lets Epic develop Unreal Engine, but is not forcing Apple to put Fortnite back on the App Store.
So if you want to play Fortnite right now on your iPhone, what do you do?
That's a good question. Well, if you already have the game on the phone, you can keep using what is known as the current season, which is different levels and progress and such. And there's people I've seen selling iPhones and iPads with the Fortnite app still on there for upwards of $10,000 on eBay. So you could do that if you'd like. But, for most people, for the 99.99%, and you don't have it on your phone already, you're not going to be able to get Fortnite on your iPhone.
Wow, that's some dedication, $10,000. So what is next? What's the next move?
What's next? Well, I think each side is looking to see who's going to bite first. If I was Apple, I'd probably be holding out another few weeks till the next hearing, the next part of this, long back and forth to see if Epic's going to say, hey, you know what, we got what we wanted, we made a big stink about this, and and Apple's not going to block Unreal Engine. We're going to just give in and put the app back to how it was before because we're losing a ton of money by not having it on the store. On the other hand, and I think Apple has more time on this one, is Apple could say, wow, are we going to start losing iPhone sales because people can't get Fortnite, an extremely popular app? So I think it's really going to come down to who bites first.
So how long and drawn out do you think this process will be? You report that the judge said this isn't a slam dunk for either side. It's really not clear.
Yeah, I watched the first hearing yesterday on Zoom, of course, and the judge and the different lawyers were talking about an actual trial taking place, in the spring, so I guess several months from now. I really think Apple could probably be okay, for the next 6 months without Fortnite being purchasable on the iPhone, but I'm not really sure. Obviously, I haven't taken a look at Epic's financials, but I can't imagine the inability to sell Fortnite on over 1 billion devices for the next 6 or 7 months is something they're going to be able to handle financially. So at some point, I think Epic's going to bite, and that's the bet Apple's making as well.
How could this potentially lay the groundwork for other apps? I mean, could what's decided here impact how other apps try to run their business, other apps lead to other apps mounting a challenge against Apple, or perhaps conceding quickly?
Yeah, I think this is probably going to scare other developers into, doing similar things that Epic Games did, right? What Apple has proven is that they're going to really enforce these rules, and no matter who you are as a developer, if you're going to break the rules, they're going to be happy to meet you in court, right? And so, they say this is not a fight they want to pick, but this is a fight they're going to defend themselves on and absolutely not give in. On the other side, the judge made some comments about Apple's businesses. She criticized them, and so, there's some worry for Apple here, too.
Okay. Bloomberg's Mark Gurman will continue to follow that story for us. Thanks so much, Mark. Coming up, we're going to be talking about which startups stood out on this year's Y Combinator Demo Day. We'll hear from a partner next. This is Bloomberg Technology. I'm Emily Chang in San Francisco. One of the world's most prestigious tech incubators, Y Combinator, is wrapping its summer demo day fully online this year. Startups from all over the world come to pitch their ideas and seek funding at this biannual event. Some of the biggest YC-backed companies include Dropbox, Airbnb, DoorDash, and Twitch. Joining us now to discuss the most promising companies this year and how it all went, Y Combinator partner Dalton Caldwell, also a longtime entrepreneur himself. Dalton, good to have you back here on the show. So there's always a huge demand for Demo Day, but this was your first fully remote Demo Day. How did it compare to years past?
Demo Day was always very much an in-person event, and it was so hard for us to imagine what an online equivalent of it would be. So we spent the past 6 months writing custom software, testing out Zoom, load testing it to translate the whole thing. And honestly, it went better than we expected. We had 1,600 investors participate over the past couple of days, and over 25,000 introductions were sent between the investors and the startups. So as far as we can tell, that's about as good as we could hope for. It was good.
You looked at almost 200 companies, right, from 26 different countries. What in terms of the trends, in terms of the kinds of companies that are being started right now? Obviously, we're at an unprecedented time in world history. What stood out to you?
There's a lot about the future of work in terms of working remotely or collaborating remotely. There was a lot about education, of how we educate people remotely. There was a lot happening in commerce. It's going to be hard to fathom how many changes to our daily life is going to happen because of COVID. And so what we saw a lot of the startups this summer do, what the big trends were, is to contemplate what does life look like in a post-COVID world. As far as I can tell, what life looks like is spending a lot of time on video calls, just like this one. It's super exciting to see.
you characterize the challenges facing startups right now, not being able to do in-person meetings, a tech landscape that is shifting dramatically, a lot of more established companies seeing layoffs, companies that maybe could have been great, not having a chance to grow at this time because they can't get additional funding?
I think that the kind of founders who we see thrive the most are those that are very flexible. They're able to deal with change, and they're able to react to immediate market conditions quickly. And so we've seen people have to change their ideas, change their market on a dime. And the people that are the most optimistic and able to quickly change their business, the ones that are doing the best. And frankly, the investing environment that we've seen at the current demo day is much higher than I would have expected. You know what's going on in the stock market right now? There's a little bit of that seems to be happening in the early stage market, where we're not exactly sure why, but there's quite a bit of money out there right now.
Absolutely. We're talking about it every day. The market's continuing to rise despite some of these extremely grave conditions. We're in the middle of a recession, a rise in joblessness, and yet investors are still optimistic. TechCrunch reported a startup called Trove raised $60 million from Andreessen Horowitz just before demo day. They decided not to participate. Is that indicative of a broader trend? Is that a one-off? What does that signal to you?
I don't know the details on that one, but I would definitely tell you, just like I saw last batch and every batch, there's sometimes companies that capture the imagination of investors and everyone wants to invest in them. And this stuff happens every batch. And so I don't know about that specific case, but it's not like everyone went home, just like what's happened in the stock market. If you capture the imagination of investors and you get them excited, it's amazing what could happen. I would not say that is normal and standard for everyone, but we're definitely seeing it happen in this batch.
Now, Y Combinator has evolved so much over the years. I've interviewed so many different YC partners, Paul Graham and Jessica Livingston, the co-founders back in the day. More recently, there's been criticism that YC has gotten too big, that the companies that are attached to the YC brand are overhyped and don't necessarily deserve it. There's concern that YC is just looking at too many companies, and it doesn't matter necessarily as much to have that YC stamp. How do you respond to that criticism?
The quality of the recent batches has remained really high. If you look at the number of billion-dollar companies that have come out over the recent years, companies like Rappi or Brex or Podium or Ironclad, I don't know, I could pull up a whole list that are very recent vintage. The quality is definitely there. And, we take a lot of pride in the fact that there's all these fantastic companies to fund. And that's why the batches have been getting bigger. We're not lowering our bar. If anything, it's much harder to get into YC than ever has been. And we see no reason to change that. Telling people we're not going to fund them to try to make it seem more exclusive or something like that was never in our DNA in the past. And I don't see that becoming part of our DNA in the future.
And what are you doing to reach more people from underrepresented backgrounds? Of course, we've seen this crescendo in the Black Lives Matter movement. I know you've been working hard on gender over the years. What are you seeing on your side in terms of progress?
The thing that's been most successful that we've done has been outreach, outreaching to people at the university level, outreaching to people that are trying to enter the tech industry. Also, if you look at the batch, there's a lot of people outside of the US. And so it's become less of a US centric thing as the batches have grown. And so there's still a lot more work to do, but all these outreach efforts have shown pretty good results thus far. And so we're just going to keep doing more of it.
So what's your advice to an entrepreneur or aspiring entrepreneur out there who's looking for that big break, maybe has a great idea, but doesn't necessarily have the connections to make it happen organically?
Well, one of the things that I always liked about YC is that you don't need an introduction. The entire model was that you would just go to a website and apply to it. When I remember starting my first company and trying to raise money for it, you needed introductions to people. You needed warm intros. And so the fact that YC has been something that anyone can apply to anywhere in the world without an introduction, I think is pretty good. And I would recommend applying to that person. I think the other thing I would say is to the extent that people out there can develop their technical skills and make sure there's a technical co-founder on the team. That is the single biggest thing that I've noticed in startups that are seeking funding that makes it hard, is that there's no one that can that's technical on the team, and that's certainly something that people could fix.
All right, some concrete advice there. We appreciate that. Y Combinator partner Dalton Caldwell, congrats on wrapping your first remote demo day. We'll have to check in with you later in the year to see how it's going. Okay, coming up, our continued coverage of the FTC antitrust investigation of Facebook and how likely the social network is to being forced to break up. That is next. This is Bloomberg. As we've been covering, the FTC is investigating Facebook for possible antitrust violations, specifically its controversial acquisitions of popular apps like Instagram and WhatsApp. Although the FTC may be able to show those acquisitions were illegal, how big is the possibility of Facebook actually being broken up? For more, I want to bring in Bloomberg Intelligence's Jennifer Rhee, who's been following this closely. So, Jennifer, how big is that possibility?
I don't think it's a big possibility because I think the precedent for actually breaking up a company comes from Microsoft primarily. And that's the best analog, I think, for this case. And in that case, what the court said was that there has to be some measure of confidence that there's been an actual loss to competition that needs to be restored before you enact a radical structural remedy like that. And I think the problem here is that that's practically impossible to prove. We know Instagram is really successful, well-liked, that it's doing really well today, but it's very difficult to say what would have happened if the company hadn't been acquired by Facebook. And also, I think it requires a judge to kind of make a prediction and look in a crystal ball, and judges really don't like to do that.
What about the fact that Instagram was, 12 employees when Facebook bought it? People forget that back then it was such a small company and nothing like it is today.
That's exactly right. It was really small. It made no revenue at all at the time that it was acquired. And in fact, the UK Competition Authority, as well as the FTC, both reviewed that merger, meaning, they dug into the documents, they talked to executives, they spent some time looking at this. And the FTC voted 5-0 not to try to block the deal. We don't know why, because they didn't publish any rationale. But the UK published a really long report, and they said they asked specifically whether Instagram could down the road become a viable competitor to Facebook. And in looking at the evidence that existed at that time, they decided that wasn't the case. And so I think it's going to be really important. A judge will look at that in court, and they'll want the FTC to explain why it was that two very competent competition commissions, agencies, reviewed the merger and felt that it was just fine. And I also think it means there are documents out there that look a little bit different than the documents that we saw publicized by the House hearing a few weeks ago. It may mean there are documents that contradict the documents that were made public in which it looked like Facebook was worried about Instagram as a future threat.
Mark Zuckerberg recently testified before the House Antitrust Subcommittee, along with the CEOs of Amazon, Apple, and Alphabet. Do you think Zuckerberg's testimony had an impact on this FTC investigation?
I think probably not, other than putting pressure on the FTC that was already there. I mean, they're well into their investigation, I think at least over a year now. We know they recently deposed Mark Zuckerberg, and the chairperson of the FTC, Joe Simons, had talked about this investigation and if they were going to bring a suit, trying to bring a suit before the election. And that was a long time ago he said that, and I think things are a little bit different. COVID hit after that, and I think they may be a little bit behind that time schedule. But, they were already well into this and very interested in looking at this and moving forward. So if anything, it just sort of added fuel to the already existing fire.
So what is next? When do we expect a decision here?
Well, I think what's going to happen next is if the FTC decides Facebook did violate antitrust laws, they're going to have to file a lawsuit. They can do it internally or they can do it in federal court. And in this case, this is a really important suit. It's precedent. It could be precedent making. I think they'd go to federal court to do it. I don't think that's going to happen before the first quarter. If they've just opposed Mark Zuckerberg, and I've read they have other depositions still to do, it's likely that they're not going to be able to get this concluded and ready for a lawsuit this year. So I would think maybe in 1Q we could see something. And then, Emily, it's going to be a waiting game because that starts the litigation. But it could be a couple years after that before, we know anything, because even if Facebook loses in trial, which could take a couple years after the FTC sues, it could appeal that decision. And nothing is going to happen. There would not be an order to divest enforced until the end of that appeal. So we could be looking at anywhere from 3 to 5 years, before we really know anything here that could impact the company.
Quite some time. Okay, Jennifer Rhee of Bloomberg Intelligence, thank you so much for breaking that down. Moving on now to the natural disasters across the United States. Hurricane Laura is expected to strike Texas and Louisiana over the next 24 hours, while here in California, still battling 2 of the largest wildfires in the state's history. Bloomberg's David Weston spoke to the U.S. Energy Secretary Dan Brouillette earlier today about how the Department of Energy is preparing for potential power outages.
We are very prepared for this hurricane that's seemingly moving into this Houston, southwest Louisiana area. As you know, the Houston Channel is there. Port Arthur, big, huge refinery is down there. Several other important pieces of our oil and gas infrastructure are down there. We have a specialized office here at the Department of Energy that is directed by an assistant secretary that is responsible for our CAT response. Their teams are already evaluating this. We're working closely with the industry. We feel that the industry is very well prepared for this type of storm. In addition to that, the president has directed me to make available the Strategic Petroleum Reserve in instances like this. That's what it's there for. We are doing all that we can to ensure that we are capable of doing that immediately following this storm. So we feel overall we're very prepared. At this point, we'll have to just watch and wait and see where the storm ends up.
Secretary Brouillette, let's move out to California, where there have been these brownouts, basically power going down at various times because it's been very hot, without a doubt. What's going on there? Is there some more fundamental problem?
Oh, absolutely. There's no question about it. California has a long history of getting energy policy wrong. You may recall the blackouts, the brownouts from 2001. There was a market issue back in that point in time where people were manipulating the market, but they were manipulating it because of the wrong policies that California chose to implement at that time. We're seeing some of that replay today. What California has decided to do is to move to a 100% renewable energy generation world. The challenge with that is that, when the wind doesn't blow and the sun doesn't shine, yet people want electricity, it isn't there. So their overall strategy is to borrow electricity or buy electricity from their neighboring states like Arizona and Nevada. The challenge, with that strategy is that when it's hot in California, sometimes it's also hot in Arizona and Nevada, and they may choose to keep their base load power and keep their electricity because they'd like their hospitals to run just fine and air conditioning to work there as well. So there's nothing to sell to California. And that leaves California in the awful position of having to turn off the lights in certain parts of the state in order to meet their energy needs.
So that takes us to that fundamental fork in the road right now, at least between Democrats and Republicans, over renewables and avoiding emissions on the one hand and really relying upon fossil fuels for energy independence that I described. Right. At the same time, the Pew Center did a study back in June and said that 60% of Americans really are concerned about climate. I will say it heavily skews toward Democrats. Democrats and Republicans see this very differently. Can we have a bipartisan energy policy in this country?
Sure you can. I mean, natural gas is a very clean source, and we're developing technologies here at the U.S. Department of Energy to make it even cleaner. We're also developing technologies to make, carbon-intense fuels like coal even cleaner. And of course, we always, have had nuclear power for the last 70 years, which is entirely emissions-free. So, I mean, you can do both. You can have a renewable generation base, and you can have an emissions-free baseload generation available to you. You just have to choose to do it. And I think that's what the fundamental problem is in places like California. They've relied too heavily or focused too heavily on renewable power like wind and solar at the exclusion of some of this base load power, which you absolutely need in today's world to ensure that you have the energy you need when you need it.
President Trump's administration has done a fair amount in trying to really, as I say, reinforce energy independence for the United States, relying in part, in significant part, on fossil fuels. What's left to be done if he's elected for a second term? What's on your agenda?
Well, we need to continue to build out infrastructure. So, as you and I have discussed in the past, we have done a great job in America of increasing our production, making ourselves energy independent, relying on new technologies or newer technologies like horizontal drilling and fracking to allow us to increase production of these resources here in the United States. Our challenge today is actually getting the product to market. It's building out pipeline infrastructure to get it to the oceans, to get it to the coastlines. It's building export facilities so that we can make this oil and gas available to the rest of the world, because they're going to continue to use these types of fuels for the foreseeable future, perhaps as many as 40 to 50 years out.
Dan Brouillette there, the U.S. Secretary for Energy. All right, coming up, Palantir to make its public debut. The data mining company, backed by billionaire Peter Thiel, broke years of suspense by filing to go public through a direct listing. We'll take a deeper dive into the filing next. This is Bloomberg. Back to our big story this hour. Palantir has filed for a direct listing on the New York Stock Exchange under the ticker PLTR. Joining us to discuss our U.S. Deals reporter, Crystal Z, who's been pouring through the filing. And Crystal, I know you still have some pages to go through, but some of the highlights: revenue climbing almost 50%, but still losing money. Walk us through the financials.
Yeah, they finally opened their books. They're known to be a secretive company, so very excited to look into the financials for the first time. The company has been around for 17 years, and it has reported that they have never turned a profit in the 17 years they've been founded, and they might not. They're warning investors in the prospectus. And like you said, they have been reporting a 50% growth in terms of revenue, and the first half net loss has narrowed compared to prior years. And we're still going through it, but when we have more, we will have it updated on our stories.
So let's talk about some of the more colorful details. Obviously, they added a woman to their board fairly recently, a former Wall Street Journal reporter. That was kind of controversial at the time. And Goldman Sachs, as I understand it, actually has a rule that they have to have a woman on their board. Tell us a little bit more of the backstory here.
Yeah, our colleague Lisette has reported that Palantir actually added a female board member for the first time this year. And she joined the board in July, and she's a former Wall Street Journal reporter and the only person on the board that does not have a direct connection with the company. The rest of the board members are the CEO, the co-founders, founding employees, the president. But she's the newest member. And like you said, Goldman Sachs has a policy which they do not sponsor or not underwrite or advise IPOs or direct listing that does not have any diversity on their board. So, the controversy here is that did they add her to the board because of, the diversity factor? And actually, Palantir explained it in their prospectus why she was added. It's because of her business acumen and unique perspective she brings as a journalist, as I quote.
Talking a little bit more in the filing about just how their software is used. They say they use their software to target terrorists to keep soldiers safe in their work with the U.S. Defense Department. Some not-so-subtle digs at Silicon Valley here, saying they share fewer and fewer of the tech sector's values and commitments. They've repeatedly turned down opportunities to sell, collect, or mine data. Anything you've seen so far that surprises you?
Not really surprising that they're somewhat slamming Silicon Valley. They moved their headquarters from Silicon Valley to Denver before the listing. So I think they're really trying to, distinguish themselves from any other Silicon Valley technology company. And they are not. They are very close to governments, to the Defense Department. So, it's a lot of military language is used in the prospectus, which is very interesting, and you don't see in any other tech company.
So what's the timeline here? How soon could this hit the public markets?
Yeah, that's not disclosed in the prospectus. We're expecting it to get done sometime this year. As we have reported that it will be a very, very busy September with many deals to come. Yesterday, we saw like 6-7 filing. Another direct listing, Asana, also filed yesterday. And there are like software companies like Snowflake, et cetera. And of course, Airbnb is going to come. So we're expecting this to be a very busy year for listings and IPOs.
A busy year for listings, a busy fall for you. Our deals reporter, Crystal Z. Thank you so much, Crystal, for that update. We'll let you get back to the S1. And that is all for this edition of Bloomberg Technology. Thanks so much for joining us today. I'm Emily Chang. Stay tuned for Bloomberg Daybreak Australia next. This is Bloomberg.